Ever get that feeling like the financial world is just this giant, intricate machine, operating just, beyond your grasp? You sense the power, the potential for things to go spectacularly right or, well, spectacularly wrong. But the inner workings, still a mystery. Today we're cracking open the hood on one of those spectacular wrong turns, the 2008 financial crisis, and we're doing it through the sharp lens of Michael Lewis's The Big Short.
Yeah, and it's more than just a history lesson, isn't it? Lewis's book really dissects the fundamental flaws within the financial system, flaws that didn't just allow the crisis, but in some ways kind of paved the way for it.
Right.
So our goal here is to pull out those core insights, those moments where the seemingly complex becomes, well, startlingly clear. And understand how a handful of individuals saw this looming catastrophe while, the vast majority just remained oblivious.
Absolutely. And let's face it, terms like mortgage-backed bonds, CDOs, credit default swaps, they can sound like a different language. We're not aiming for a finance seminar here, but we will illuminate these instruments as they become crucial to the story, making their role in this whole drama understandable.
Yeah, basically.
Think of this as your express route, maybe, to grasping the essential issues and the truly mind-blowing facts behind the 2008 meltdown. Okay. Let's dive in.
Okay, so one of the most compelling things in Lewis's narrative is how these early warnings emerged. These contrarian thinkers, people who, often against the tide, identified really deep problems.
Like John Paulson.
Exactly. Take John Paulson.
Yeah.
His massive bet against subprime mortgages. It wasn't just a lucky gamble. It yielded billions. And that kind of profit, it wasn't just one successful trade. Lewis makes the point. It pointed to a colossal mispricing of risk across the entire financial landscape, really.
Yeah, it makes you wonder how often those massive blind spots are lurking, right? In markets we just assume are efficient.
Absolutely. And then you have Meredith Whitney. Her very public warnings about the instability of major financial institutions. Chillingly accurate.
It's almost bewildering in hindsight, isn't it? That these clear voices weren't amplified and, heeded more. It brings to mind that quote at the beginning of The Big Short.
Oh, yeah.
You can explain the most complex idea to someone who knows nothing, but you can't explain the simplest thing to someone who is absolutely convinced they already understand it.
That perfectly captures it.
The mindset on Wall Street at the time.
Exactly. This unwavering conviction, even when faced with evidence pointing the other way, it's a recurring theme. Lewis introduces us to Steve Eisman and his team, Vinny Daniel, Porter Collins, Danny Moses. Their initial unease with subprime lenders actually goes way back before the boom.
Right.
1990s.
That early?
Yeah. Eisman's 1997 report, and then the failures of some early subprime lenders. That should have been a warning. But they were largely dismissed amidst all the economic optimism.
Right. So Eisman and his team had this kind of dark, skeptical view, a real departure from the prevailing bullishness.
Totally. And Danny Moses, his background, his inherent suspicion of anything sounding too good to be true on Wall Street, he brought this really sharp, critical eye. He even had that memorable line, didn't he? About always expecting Wall Street to find a way to, well...
Fuck him, yeah. Shaped his whole approach.
Exactly. And then there's Michael Burry. His story is particularly fascinating.
Agreed.
His perspective was partly shaped by, well, his physical difference, his glass eye, and what seems to be Asperger's syndrome. This led to an intense focus on data, this remarkable ability for independent analysis, and a certain detachment, maybe, from the social pressures of Wall Street.
Yeah, you see that in his early online blogging about his stock trades. It wasn't about seeking validation. It was this meticulous, almost obsessive documentation of his reasoning. It attracted a following, people who appreciated his analytical rigor, someone not just echoing the usual market noise.
And that fiercely independent thinking was crucial when he turned his attention to the subprime mortgage market. He grasped the basics of a credit default swap, like buying insurance on a bond, right?
Right. Bond defaults, you get paid.
Simple enough for corporate bonds. But swaps on mortgage pools, much trickier because of how defaults would happen sequentially. The whole pay-as-you-go solution from Deutsche Bank and Goldman, innovative, sure, but it also kind of obscured the underlying risks.
What's so striking about Burry is his fundamental distrust of the system itself.
Yeah.
He wasn't just betting against a few bad apples, he was betting against the entire orchard,
That's a good way to put it.
That's why he insisted on collateral from giants like Goldman and Deutsche Bank. It wasn't about doubting them individually. It was acknowledging the systemic fragility he saw.
And his analysis was incredibly granular. He wasn't just looking at broad ratings. He was digging into The loan specifics, loan-to-value ratios, second mortgages, property locations, the lack of documentation for so many loans.
That deep dive approach let him spot the riskiest bonds.
Yeah, and he was genuinely surprised, Lewis writes, that Deutsche Bank, initially anyway, seemed to treat all subprime bonds as basically the same. They seemed heavily reliant on the rating agency's assessments.
While Burry, with his detailed analysis, could see huge differences in quality.
And this reliance on ratings, it's a crucial point we'll definitely come back to. But think about how credit default swaps were priced, largely based on these ratings.
So AAA-rated tranches were cheap to insure.
Right, while the riskiest, the BBB-rated tranches, cost way more. Burry's focus on those BBB tranches, the ones first in line for losses, even with relatively few defaults, shows how deeply he understood the fragility.
There's that incredible example, right? Burry finding a mortgage pool that was entirely floating rate, negative amortizing mortgages.
Unbelievable. People borrowing more money each month just to cover interest, if that.
And Goldman Sachs sending him a congratulatory note for being the first to buy insurance on that.
Yeah.
It just underscores Burry's early grasp of the sheer absurdity. He was, as he put it, educating the experts.
And ironically, as more Wall Street firms jumped into this market, creating these swaps, it actually made it easier for Burry to place bigger and bigger bets. What started as $10 million pops became $100 million.
A staggering amount, like trying to empty the ocean with a teaspoon, as he said.
Yeah. But his contrarian stance wasn't easy. His investors, initially thrilled with his stock picking, they grew really uneasy with this massive bet against the subprime market.
They couldn't grasp why a stock guru should suddenly have this insight into murky mortgage securities, right?
Exactly. It highlights that fundamental difficulty, doesn't it? Going against the grain, convincing others when you challenge the accepted story. Burry even coined that phrase, defender of the idea, recognizing how hard it is to change your own mind once you're constantly defending it. His attempts to explain his billion-dollar position were often met with, resistance. Doubt.
And then the plot thickens. Greg Lippmann at Deutsche Bank suddenly wants to buy Burry's credit default swaps.
Right. And then Goldman comes knocking. Bank of America, Morgan Stanley.
The very firms who were selling the insurance now want to buy it back.
It strongly suggests a big shift in their internal view of the risks, as the housing market started wobbling.
It's a huge signal, and Lewis mentions that anecdote, the guy with the 42-page presentation.
Yeah, who independently reached a similar conclusion about default rates rising.
So it wasn't just Burry, others were seeing the cracks appear too.
Definitely.
Okay, let's shift focus a bit. The role of rating agencies and these incredibly complex financial instruments. We hear a lot about AIG, specifically AIG Financial Products, AIG-FP. Can you unpack their significance here?
Sure. AIG-FP basically grew out of the bond trading desk at Drexel Burnham, post-Milken. They claimed they had this superior model for trading complex things like interest rate swaps. The key thing, though, AIG-FP wasn't a traditional bank.
Meaning fewer regulations?
Exactly. Not subject to the same strict rules, especially capital reserve requirements. This let them take on enormous amounts of risk without having to disclose it publicly or hold huge reserves against potential losses.
So they were operating in a kind of regulatory blind spot.
Precisely. And their apparent success led to copycats, Zurich Re FP, Swiss Re FP, others like them. These non-bank financial product companies collectively became huge absorbers of the complex risks the system was generating. Without them willing to insure this stuff, the risks would have been much more visible, probably scrutinized by regulators much sooner.
And Greg Lippmann, who we mentioned wanting to buy Burry swaps, he faced pushback trying to persuade investors to bet against subprime, right? What were the objections?
Well, the standard Wall Street cynicism was there. If this is such a sure thing, why offer it to me?
Right.
But also specific things about the swaps. Investors hated paying premiums year after year, waiting for defaults that might not happen on their timeline. The whole idea of positive carry trades that pay you just to hold them was deeply ingrained. Paying 2% a year on a swap felt wrong to many.
Okay.
Others just didn't understand the instruments well enough to explain it to their investors, or they trusted the ratings, or what firms like Bear Stearns were saying.
And the internal culture at AIG FP Lewis paints Joe Cassano's leadership as, well, not great.
Yeah, the picture is one of demanding obedience, suppressing dissent about risk. Traders describe, crafting presentations carefully to avoid challenging Cassano's often simplistic grasp of complex products. He seems to have had maybe a limited understanding of risk management nuances, but a real talent for intimidating people who questioned him.
Sounds like a place where critical analysis of the dangers might have been actively discouraged.
That seems fair.
Yeah.
And Lippmann saw this disconnect. He had this tug-of-war analogy. He really is the people closest to the mortgage bond market, even in his own company, were often the least likely to see the flaws.
Interesting.
So that led him to target a different audience, stock market investors. He tried framing the bet against subprime as a hedge for their real estate stock investments, appealing to their fear of a housing collapse.
There's that moment in May 2006, S&P announced they were changing their rating model for subprime bonds effective July 1st. What was the immediate reaction?
A frantic rush to issue as many subprime bonds as possible under the old, presumably easier rating rules.
Wow.
As Vinny Daniel put it, the big firms were stuffing the channel, trying to get their, let's say, less than stellar securities rated before the tougher standards kicked in.
That frantic activity really suggests even the creators suspected their quality wouldn't hold up under scrutiny.
You'd think so, wouldn't you?
So we've got these early warnings, a culture in key places, stifling dissent, rating agencies about to get stricter. Let's dig deeper into the actual flaws these short sellers were exploiting.
Okay. So Burry, as we said, focused on the loan structures, identifying pools almost designed to fail. Eisman and his team, more boots on the ground, looking at borrowers, lenders, regional differences in defaults.
Right, like Georgia versus Florida, Indiana versus California. Those comparisons raised flags.
Exactly. Despite similar economies sometimes or counterintuitive results, like California having lower defaults initially, it pointed to deeper issues.
And their trip to Miami really brought the abstract data to life, didn't it?
Oh, absolutely. Driving through those empty subprime developments, a visceral sense of the overbuilding, the potential for defaults. Not just numbers anymore. They're actively seeking out the most rotten bonds, targeting those concentrated in the sand states, California, Florida, Nevada, Arizona.
Where prices had shot up unsustainably.
Right. And focusing on loans from lenders known for lax standards, like Long Beach Savings, later WAMU, and bonds heavy with low-doc or no-doc loans, which were ripe for fraud.
The strawberry picker example.
Yeah, the Bakersfield strawberry picker, minimal income, gets a $724,000 mortgage. It just shows the sheer irrationality, the breakdown of basic lending.
And the rating agencies, the supposed objective arbiters, how were their models being so effectively gamed?
Well, Wall Street had a huge incentive to get the highest ratings, right? Made the bonds easier to sell and for more money. They quickly figured out the agencies weren't doing rigorous loan-by-loan analysis. They were looking at pools based on broad stats, like average FICO scores.
And FICO scores themselves could be flawed or inflated.
Exactly. So the focus wasn't on the actual quality of each mortgage, but the overall statistical profile of the pool.
Which created loopholes.
Tons of them. Agencies tended to favor floating rate loans with low teaser rates. They often ignored unsustainable housing booms, overlooked fraud and no-doc loans, blind to silent seconds.
Undisclosed second mortgages leaving borrowers with no equity.
Right. Every time Wall Street found a blind spot in the agency models, it was a new chance to package and profit from even riskier loans.
Which leads us to CDOs, collateralized debt obligations. How do they fit in?
CDOs were basically repackaged slices of those mortgage bonds. Think of taking the mortgage bond cake, slicing it into different pieces or tranches, each with different risk levels.
Senior tranche is safest, paid first. Junior tranche is riskiest, absorb losses first.
Exactly. And many investors bought credit default swaps, not directly against the mortgages, but as a hedge against these CDO tranches defaulting. Insurance on the repackaged slices.
And then we have Charlie Ledley and Jamie Mai of Cornwall Capital. Their entry into this was almost accidental.
Yeah, fascinating story. They spotted market inefficiencies unconventionally, made a good bet on Capital One options based on Joel Greenblatt's book, and through that, they realized long-term options, LEPs, were often mispriced.
Because the standard Black-Scholes model didn't account well for extreme unexpected events.
Precisely. Like the regulatory trouble Capital One faced, it didn't fit the normal distribution assumption.
So they built a strategy around finding cheap options on assets poised for big changes, even without deep knowledge of the asset itself.
Right. Their insight was that markets often dramatically misprice the probability of these black swan events.
They embraced uncertainty, made small bets on low probability, high payoff outcomes.
Yeah, and they relied on experts for the details. They admitted they didn't need to be the authority on everything they traded. Their strength was spotting potential mispricings in the broader market dynamics.
But they faced challenges as a small firm, right? That impenetrable fortress feeling trying to trade with the big guys.
Oh yeah, constant struggle. Getting access, fair pricing. It took Ben Hockett, the ex-derivatives trader with connections, to get them onto Deutsche Bank's institutional platform.
A big breakthrough.
Huge. Allow them to execute trades properly.
And it was Cornwall who really zoomed in on the CDOs, especially those triple B tranches.
Yes. They saw the ratings were totally disconnected from reality falling home prices, trouble brewing with the ABX index tracking subprime bonds. The ratings were just too good to be true.
And they asked that key question.
Who the hell is taking the other side of this trade?
Yeah.
And the answer, mostly the CDOs themselves, insuring each other.
Circular logic, highlighting the instability.
Exactly, which eventually led them to a different strategy than Burry or Eisman. They started betting against the AA-rated tranches of CDOs, figuring if the lower tranches were doomed, the supposedly safer upper ones couldn't be far behind.
Which brings us to that legendary meeting, Steve Eisman and Wing Chow, the CDO manager.
Ah, yes. Danny Moses' instant assessment of Chow sucker. Just incredibly tough.
Chow represented the end buyer of these complex things, and his understanding seemed superficial.
That was Danny's take. And Eisman, after maintaining some politeness during lunch, had this profound reaction. He basically declared, whatever that guy is buying, I want to short it. He specifically targeted Chow's CDOs, even without knowing the details.
He'd found the embodiment of the flawed thinking, the willful ignorance.
In his view, yes.
So the short sellers are gaining conviction, bets are placed, doubts are creeping in elsewhere. Let's talk about the American Securitization Forum conference in Vegas. What did that reveal?
Vegas was basically a massive party celebrating the subprime industry's supposed success. You had these crazy displays of wealth, John Devaney's Renoir, his yacht right alongside the underlying rot in the market they were celebrating.
Stark contrast.
Totally. Eisman's team skipped the main talks, went for private meetings, trying to get honest assessments behind closed doors.
And the tragic irony of the actual homeowners working service jobs at the conference?
This underscores the disconnect, doesn't it? Between the financial engineering and the real-world impact. Deutsche Bank, who'd helped set up some meetings for Eisman, was even trying to monitor him, worried he was there to short the bonds they were pushing.
They even gave him marketing materials for buyers by mistake.
Yeah, hilarious.
And then the confrontational exchange between Eisman and the Option 1 CEO about default rates. Classic Eisman.
Oh, yeah. The CEO confidently says maybe 5% loss rate. Eisman finds it ludicrous, holds up his fingers for zero probability of that, then abruptly leaves after faking a call from his wife, who admitted later she was just a prop for his exit.
Just utter contempt for the inaccurate optimism.
Pretty much. The conference also highlighted the gap, status-wise and knowledge-wise, between rating agency staff and the Wall Street traders exploiting their models.
The agency folks seemed out of their depth.
Often, yeah, like minor characters who didn't grasp the plot. Tasked with rating complex stuff, but not understanding the underlying mortgages, or even recognizing the traders making fortunes off the flaws.
And despite mounting evidence, that 5% expected loss rate remained the industry party line. Collective denial.
Feels like it. For Eisman's team, Vegas was pivotal. Their view shifted from credit issue to fictitious Ponzi scheme. The question became less, are we missing something? And more, are these guys morons or criminals?
Wow.
Vinny Daniel tried, unsuccessfully, to persuade Fitch Ratings to be the honest agency. That just reinforced their cynicism.
So, post-Vegas, the conviction is even stronger. What were the early signs the unraveling was actually starting?
Well, Charlie Ledley and Ben Hockett came back, convinced the system had lost its mind. They saw contradictory signals, publicly traded subprime CDOs falling in price, but their own AA-rated CDOs still valued at par.
And the explanations from Morgan Stanley and Deutsche Bank were unconvincing.
Yeah, convoluted, technical, didn't add up.
And Morgan Stanley's sudden refusal to sell more subprime insurance, that was telling.
Huge shift. Overnight, from selling to refusing. Vaguely citing risk management elsewhere in the bank. Surprisingly, Wachovia kept selling cheap insurance, with Bear Stearns acting as middleman for Cornwall, like the last life raft salesman.
But then the bigger firms got hesitant to sell swaps even as the market weakened. Counterintuitive.
Yeah, raised suspicions. Cornwall suspected Bear Stearns traders might be buying swaps for themselves, anticipating the downturn, fueled by that optimistic Bear Stearns analyst report dismissing concerns as just market sentiment. Charlie Ledley found that incredible given the price gaps.
Yet despite all these red flags, Merrill Lynch, Citigroup, others kept creating and selling new CDOs. Hard to grasp.
It shows how driven the market was by sheer volume and interconnectedness. The scale made it hard for major players to change course, even as the collateral crumbled. Bear Stearns pulling a How to Short a CDO presentation from its conference speaks volumes about wanting to maintain the illusion.
And the rating agencies finally acknowledged problems, reconsidered models, but their response was inadequate.
They announced a reevaluation, yeah, but refused to actually re-rate the trillions already out there with high ratings, including the ones Cornwall was shorting. Reluctance to admit past errors, downgrade securities, it just eroded their credibility further.
And Cornwall started buying swaps on Bear Stearns itself.
Yeah, recognizing Bear's increasingly shaky position.
We also hear about HSBC's early loss announcement. That predated the crisis becoming mainstream news.
It did. February 2007, stemming from their household finance acquisition, a big subprime lender, one of the earliest public acknowledgments from a major bank about the brewing problems.
And as distress became more visible, how are the short sellers reacting? Eisman was ramping up his shorts.
Aggressively. But facing resistance from risk management at Front Point, who didn't seem to grasp the potential scale. He recounts that dismissive meeting with a Bear Stearns salesman trying to downplay risks. Just solidified Eisman's bearish view.
Lewis calls Eisman's deep dive the Great Treasure Hunt. What were the most shocking discoveries?
The truly shocking thing was realizing even CEOs of major banks seemed clueless about their own balance sheets, their subprime exposure. His epiphany about Ken Lewis at Bank of America bluntly assessing him as dumb regarding these complex instruments is memorable and disturbing.
Lack of comprehension at the top.
Deeply concerning. Led Eisman to short the banks themselves. BofA, UBS, Citigroup, Lehman. Not Morgan Stanley, though, because of a client's ownership stake.
And critical voices in the press, like Jim Grant, were getting louder.
Grant, always a skeptic, tasked his assistant, Dan Gertner, with understanding CDOs. Gertner couldn't make sense of them. Grant concluded if Gertner couldn't, likely no one truly could. Their articles slammed the agencies for rubber-stamping opaque risk, led to an uncomfortable meeting with S&P.
Okay, we've seen the warnings, the slow realization.
Yeah.
Now, the height of the crisis, mid-2007 to early 2008, how were our protagonists reacting as things teetered?
Michael Burry, reading Grant's critical articles, felt validated, but also more isolated. He'd pinpointed the core problem, lending to people who couldn't repay way back in 2003. The world was finally catching up. Slowly.
And the personal diagnosis.
Right. Around then, his son was diagnosed with Asperger's, prompted Burry to realize he shared many traits. Helped him understand his unique analytical skills, but also his social challenges on Wall Street.
And his interactions with Wall Street firms over swap valuations got really strained.
Yeah, increasingly felt firms like Goldman, Morgan Stanley were manipulating the values, demanding excessive collateral based on biased interpretations. He believed they were warehousing risk themselves, trying to inflate the market to attract capital, fix their own problems. Saw it as manipulation.
Prices not reflecting the real, rapidly increasing risk.
Exactly. And his own investors became a huge source of frustration.
They trusted his stock picks, but not this huge macro bet.
Right. As the housing market faltered, showing initial paper losses on his swaps, though he was sure he'd be right, they demanded more info, questioned the strategy. Burry preferred autonomy, found constant explaining draining, got frustrated with their short-sightedness.
Leading to the controversial side pocketing.
Yeah, locking up a huge chunk of investor capital indefinitely, met with anger, disbelief, legal threats. His defiant quarterly letter justifying it just poured fuel on the fire.
So early 2007, Ledley, Eisman, Burry, distinct views on the storm.
Ledley at Cornwall saw a system corrupted by bad incentives, disregard for risk basics. Eisman at Front Point saw stupidity mixed with willful delusion. Participants clinging to the idea that any dip was a buying opportunity. And Burry, data-driven, isolated, saw the subprime market and its instruments as outright massive fraud.
And that recurring pattern, Lewis notes, Goldman and Morgan Stanley citing systems failure when the market moved Burry's way.
Yeah, frequent systems failure or power outage excuses for delays or odd valuations. Burry saw them as transparent excuses to buy time, avoid marking positions accurately, manage their own exposures.
But June 2007 was a turning point, a shift in the big firm's perspective.
That was the month Goldman and Morgan Stanley finally started marking Burry's swaps more accurately, reflecting the deteriorating mortgage market. A huge shift. Suggested they were likely taking similar short positions, or at least acknowledging the probability of defaults. The market was finally pricing in Burry's reality.
And this coincided with teaser rates resetting on many subprime loans, the moment Burry predicted.
Exactly. Those adjustable rates jumped, payments became unaffordable, defaults, foreclosures surged. The OMLT 2005-3 pool, one Burry tracked, showed it starkly. Delinquencies, foreclosures spiking summer 2007. The music was stopping.
Let's touch on Morgan Stanley's bespoke swap from Howie Hubler. Sounds intricate and disastrous.
Incredibly risky, convoluted. Essentially a bet on the very last loans in a pool not defaulting. The flawed logic was, even if tons default, as long as a few don't, the swap doesn't pay out fully. Seemed high return, low risk. Highly leveraged bet disguised.
Based on the flawed idea that different CDO tranches had vastly different predictable risks.
Right. A fiction pushed by rating agencies, justifying high ratings, enabling Hubler's massive positions.
And the argument between Hubler and Merrill Lynch over a tiny rate difference on a multi-billion-dollar trade. Darkly comical now.
Highlights the short-sighted focus on tiny gains while the whole thing was imploding. Deutsche Bank, thanks to Lippmann's internal warnings about AAA CDOs eventually being worthless, was willing to meet Hubler's price. They saw the risk Morgan Stanley was taking.
And Deutsche Bank's wake-up call to Morgan Stanley in July 2007.
Yeah. Based on swap movements, DB demanded a staggering $1.2 billion in collateral. Lippmann's forceful negotiation got them $600 million, a clear, tangible sign of the mounting losses in Morgan Stanley's mortgage division.
Culminating in Morgan Stanley's December 2007 investor call, announcing that huge loss.
The $9.2 billion trading loss, mostly from one desk, sent shockwaves. CEO John Mack admitted an error in judgment, failure of risk management. What's telling is the bewilderment of a Goldman analyst at the sheer size of the loss. Even insiders struggled to comprehend the speed, the severity.
And Lewis implies even the CEO didn't fully grasp how it happened.
Seems likely.
Okay, final stages. The payoff for the contrarians, early to mid-2008. Cornwall, having bet against those crappy CDOs, suddenly faced vulnerability.
Right. Their long shot wasn't so long anymore. They risked losses if the government stepped in, stabilized housing, or if something like Bear Stearns collapsing caused a weird rally. Ben Hockett coming back from vacation, frantically selling their swaps as firms like UBS desperately sought insurance. Pivotal moment.
Their positions had soared in value.
Dramatically. And their timing was incredible.
How so?
The same day they finished selling, French bank BNP froze withdrawals from money market funds over subprime exposure.
Wow. And Cornwall's profit.
From just over $1 million invested, over $80 million realized.
Astounding. Meanwhile, Burry's grappling with his Asperger's insight. How did that influence his perspective?
Understanding it helped him see how his intense focus was a refuge from a world he found illogical. Framed his challenges with Wall Street's social side, his literal, data-driven approach. Realizing his unique view might be linked to Asperger's was significant personally.
And Eisman, even as markets teetered, was publicly predicting investment bank failures.
Yeah, his conference predictions coincided with news indecision. Bear Stearns needed an emergency loan from J.P. Morgan, signaled severe liquidity issues. Eisman's internal reaction, just why? About a major firm collapsing highlighted the fundamental breakdown of trust.
Bear's demise in March 2008, basically a run on the bank.
Classic run. Triggered by a sudden catastrophic loss of confidence.
By then, the stock market acknowledged the huge subprime losses, but the scale and distribution were still murky. Bear's high leverage made its failure almost inevitable. Danny Moses's observations of commuters offer a unique snapshot.
Danny, the team's eyes and ears on sentiment, noticed subtle differences in commuters' demeanor, interpreted them as reflecting roles, anxieties in the collapsing system. He was trying to process the information flood, but the speed, the scale, felt disorienting, like a black hole of uncertainty.
Then September 2008, Lehman fails. The earthquake finally hits.
And the tsunami follows. Reserve Primary Fund breaks the buck, freezes redemptions. Short-term lending rates spike unprecedentedly. Financial stocks everywhere plummet, regardless of direct subprime exposure. Danny felt utterly overwhelmed. Impending doom, old market rules gone.
Eisman and Vinny even had that unsettling realization about their own short selling.
Yeah, the uncomfortable thought that by shorting they might have provided liquidity that kept the monster, the unsustainable system, going longer than it should have. Sobering, ethically complex.
And Lewis notes the strange calm in Manhattan amidst the catastrophe. Delayed invisible consequences.
Exactly.
Okay, the epilogue. Lewis meets his old Salomon boss, John Gutfreund. Significance.
Gutfreund's 1981 decision to take Salomon public shifted risk from partners with personal stakes to public shareholders. Lewis subtly suggests this transition, maybe natural, set the stage for some excesses, reduced personal accountability contributing to the 2008 conditions.
And Burry's core concern all along, the massive opaque web of credit default swaps on banks. Systemic risk few understood.
Exactly, the danger of interconnected bets, one failure cascading. He points out even things like interest rate swaps added complexity, new, poorly understood interdependencies.
Finally, Lewis on rating interpretations. Crucial takeaway.
Wall Street treated AAA, AA readings as precise default probabilities, but agencies, post-crisis, claimed they were just relative risk rankings. This fundamental disconnect, how ratings were used versus agencies' stated intent, highlights a major systemic flaw.
So after this deep dive into The Big Short, the complexity, the interconnectedness, what's the final thought for our listeners?
Well, it really forces you to ask, doesn't it? How much has truly fundamentally changed in the global financial system since 2008? With constantly evolving instruments, increasing complexity, what new blind spots might we be overlooking today? It's crucial, I think, for all of us to keep critically examining, questioning the foundations of our financial world. Stay vigilant for future crises, potentially lurking just beneath the surface of seemingly stable markets.